We are going to start today security analysis and portfolio management. And today we'll just touch upon the Unit 1, Introduction to Investment. Now, security analysis and portfolio management both are interconnected fields of study that deal with investment decision making. There is a first part, security analysis, which involves process of evaluating financial instruments or securities like shares, debentures, etc. Part 2, its portfolio management, on the other hand, is the process of selecting and managing a group of securities known as a portfolio that meets the investment objectives and risk tolerance of an investor. Note the underlined investment objectives and risk tolerance of an investor. So the primary goal is to maximize returns while minimizing risk by diversifying investments across different asset classes, sectors, geographic regions. Now, to give an example, suppose you want to invest in, you know that steel sector is going to do well. So you find that, you analyze and find that Tata Steel is going to do well. So it is a steel. So to balance it off, you can invest some amount into an Hindustan Lever which make consumer goods. So your product portfolio now has a commodity which is basically business consumption and one which is consumed by others. So portfolio gets balanced. This is how we'll learn later on more details about how do you analyze the company, what is the risk and how we build the portfolio, etc. Let's move to the next slide. The objective of learning this course, security analysis and portfolio management. First, to understand the fundamental concepts and principles of investment analysis. Note here the point investment analysis. You need to analyze where you are going to invest your money. To learn the techniques and tools used to evaluate the intrinsic value of securities. Here we will deal with the financial statement analysis of the company, how the company is doing, the ratio analysis, the revenue, the profitability, the liquidity, etc., etc. Third, to develop an understanding of different types of risk. Now this is very important idea because there is a risk involved into any security you are going to invest, be it equity investment or investment in debenture or fixed return securities, because everything has a probability of failure or giving you a return which is less than you desired or you expected. So we have to understand the third point, to develop an understanding of different types of risk when you take an exposure to a security. Fourth, to gain knowledge of various approaches to portfolio management. Now there can be different types of way you can manage the portfolio. First, you can decide that, okay, power sector, steel sector, or any sector, different sectors will be doing well. So let us find some companies who are doing well in these areas. So you may choose some companies from steel sector, power sector, or maybe some FMCG sector, that is fast moving consumer goods like Hindustan Lever, Nestle, which makes your Kit Kat chocolates and other things. And then, or there can be the other way around, that you know this company is doing well or this sector is doing well, so I will buy this stock. So one is called bottom up, when I know the company and then try to analyze it and think whether to invest in that or not. Or I choose a sector like infrastructure, which may be doing well in the next couple of years, and then find a company there, which is called top down. Similarly, I can follow the Sensex or Nifty. I'll explain you what is Nifty and the index. There are various good stocks already shortlisted by the exchanges. So I can blindly follow those stocks and invest in them. Then comes the fifth point, to learn how to construct a diversified portfolio. Now, generally, portfolio when I invest my hard-earned money, I don't put all my potatoes into the same basket or all the eggs in the same basket. That is why I need to diversify. So if I buy some steel, I will buy something IT stocks. I will buy something FMCG, that is consumer good stocks. I can buy something telecom stocks. I can buy something of cement stocks. In this way, I will diversify. So if any sector is not doing well, it is very unlikely that all sectors will not do well. So maybe the pharma sectors will do well, whatever the reason, whatever the economic condition may be. So I will diversify some amount in pharma sector. So this is how I have to learn how to construct a diversified portfolio. And finally, last but not the least, to develop critical thinking and analytical skills or mindset. Critical thinking, because there are various things happening in the economy. So you have to think over what will affect your investment and how it will affect your investment, or at all it will affect your investment or not. And your analytical skill will tell you how much it will affect your investment, or it will not affect your investment, etc. Or your effect will be for some time. So you should need patience to go through that time. And again, things will be normal. So this is very important skill one has to learn, that is critical thinking and analytical skills. So these are the objectives of learning. We will be learning as we progress with the syllabus. Now let me introduce you to investment. A rational person who has an earning or wealth likes to keep some amount for future. What does it mean? He foregoes the consumption now. If I earn 50,000 rupees salary, I can spend the whole money, or I can keep 10,000 aside so that in future, if I need the money, I can use it. This money can be kept in a bank. This is called savings for future, you can call it. Because if I put it in a bank, it will earn some interest, and I'll get some more money for parking the money with the bank. But some people may like to take some risk and buy some assets which may give them regular income and or capital appreciation. Now, what do you mean by that? Suppose you are not keeping it to the bank because bank interest is fixed, another thing. So you want to buy a flat, or suppose you have got a lump sum money. So you know that, okay, I will get a regular income in the form of rent, another thing. And also after some time, the capital appreciation can happen. But there is a risk. Suppose for some time I don't get a tenant, I do not get the regular income, or for some reason the market, the area where I have bought the real estate gets a bad name, so the appreciation does not happen, or the market is dull, people are not buying or ready to pay a higher price. So there is certain amount of risk. As we all know, without risk, you don't get higher return. risk you have to take if you want to get more return than what you get in bank. Another thing, this is called investment. Investment can be gold, real estate. Now these are called real assets because you can touch it, feel it, everything. So gold, real estates, even in US and other places, some people invest in barrels of oil, expecting that oil price will go up. So these are real assets they're holding. And some people invest in shares of some companies or debentures issued by some companies or even bonds issued by government of India, units of mutual fund. Now these are called generally financial assets. So cash, if you hold, it is a real asset in your hand. You can touch it, feel it. But when you buy shares with the cash or mutual fund units, then it becomes that units becomes the financial assets. I hope you are getting it clear. So here in security analysis and portfolio management, we will mainly study financial assets, which are also called financial securities, because we will buy shares of different companies. To balance it off, we can also invest some amount in fixed income securities like non-convertible debenture or debentures, etc., or Government of India bonds, etc. And some amount we can keep cash in bank in case of emergency and etc. So we will be studying, and then the art of choosing the stocks or shares and how to diversify that so that at a particular time my investment does not go down or unnecessarily it does not go up very well. Both sides are a little risky, and it all will depend on my risk appetite or tolerance also. So this is investment in financial assets, with which I will go ahead in the further we study on security analysis and portfolio management. Now, it's important to understand the concept of return on investment. Invest you have do, but what type of return I'll get? In bank, you have printed rates. If you put for 40, 45 days, if you put for 1 year, if you put 2 years, how much you will get. If you buy debenture, that is a fixed income securities or Government of India bonds, you know the fixed interest I'll be earning every year, maybe once in a year or twice in a year, and at the end of the term, I will get back my principal. But if you invest in a share, if it has a history of giving dividend, dividend is share of profit. So if you have history, you can somehow or other estimate that you will be getting some dividend every year, and maybe in the market share price will appreciate and you will get a capital gain. So now the whole thing comes into how the question is how much return I want. Now it also depends on how much risk you are ready to take. But that also is not always true. So you have to analyze, and that is why we emphasize on analytical skills in security analysis. Now suppose I invest 1 lakh in a secured debenture which promises to pay a return of 10% per annum. What will happen? I will earn a nominal return, note the word nominal in bold, of rupees 10,000 after 1 year. Very good. But suppose during the same period, the price of goods increased by 10%. That means what I could have purchased with 1 lakh now goes up to 1,10,000. So I cannot buy anything extra. That means my real return will be zero. 10,000 price has gone up and I have got a return of 10,000. Both cancels each other. So my real return becomes zero. If I extend this example, suppose I invest at 8% and inflation is 10%, then actually I will lose my buying power. That means my principal with which I could have bought 1 lakh worth of goods will lose the purchasing power and I will be able to buy less amount of goods with the principal. And of course, with the interest, I can buy a little more amount, but to sum it up, my overall buying power will come down. And that's inflation, eating up your capital. The retired persons and other things, they all the time feel the punch of it. And so one should try to invest so that he earns positive return that will help to increase wealth, because that will add value to his already existing capital or the money he has. So one very important learning from this slide is one should try to understand the inflation rate. Government of India and other publishers, you can go to the market, you can yourself understand, so that he or she can target a required return, nominal rate, which is generally in print. So if you go to the bank and other things, you get a rate, which is nominal rate. If you adjust with the, say, 6% interest or 5% interest, SBI is giving against 1 year deposit. But if inflation is 6%, then basically you are losing money. That is why it is important to have the concept of inflation ingrained into your thinking system. And then you should try to calculate how much nominal rate I should get. So suppose the inflation is 6% and I want a real return, the difference between nominal and inflation, that is real return, I get 10%. So 6% is my real return I am getting on my investment. I hope I have made the point clear that if we reduce from the nominal return, which is generally printed on the board or printed on the papers, from nominal return, if I deduct the inflation going on, I will get the real return which I am earning. I repeat the example. Suppose I have earned from the bank 8% return and inflation is 5%. That means 8 minus 5, 3% is my real return. So the main learning outcome from this concept of return on investment, real and nominal, we come to know that nominal rate is everywhere we see. We have to adjust inflation with that, then we'll come to know the real return. But when we will be studying this course in future, most of the places and we will be discussing about the nominal return only. I hope I have made this point very clear. We will read about nominal return only. Now let's move to the next slide. That's a very important risk है तो इसका है. Risk and risk premium. Risk in holding financial securities. Why? Probability of default in interest payment or loss in capital value. Now this is quite possible. Suppose I have purchased a debenture which promised me to pay an interest of 10% for 5 years of a steel plant, Aarti Steel Limited or something, but for some reason company is not doing well and they are unable to pay the interest. So I am taking a risk here, whether they will be able to pay the risk or not. So I have to analyze the company very well. And finally, for some reason or other, company says that, okay, I am in trouble, I cannot return the capital now, you have to wait for some time, so you have that risk. So that is why I come to the next point. The risk-free investment is government securities, because government generally does not default. Government does not default generally in the same currency. So if you buy Government of India bonds, it will give a rupee interest to you, and government will not default. One reason is government can print currency, and government in the last 75 years, government has never defaulted in paying the interest nor returning the principal when it is due. So this is the risk-free investment. Corporate securities like debentures carry risk. I'll come to equity later on. Corporate securities like debentures carry risk. That is why whenever there is a company issuing some debentures or fixed income securities, these are rated. You will know about the rating agencies, AAA, AA, A, triple B, like this. So if you are buying government securities, you may get 6.5% interest. But if you are buying a Larsen Toubro or Tata Steel or Ultratech Cement debenture, you may, because there is a risk. They may be a top grade company, AAA rated company, but there can be a risk of, for some reason, suppose cement industry is not doing well, they are not getting paid by the government, whatever it is, they default in there. The probability is very low for AAA companies, so you will expect a premium because you are taking a risk. But the same debenture, if it is of an unknown company, the risk is high. So you will expect more return. Now suppose somebody gives gold loan like Manappuram and other things. They are issuing debentures. They will pay you 10% or 12% interest when Government of India, which is giving you 100% security, risk-free, is giving you 6.5%. Then Shriram Finance or Manappuram will be give you 10%, 9%. So this 3% extra what you get is in the fourth item, risk premium. This is the extra return investor expects for taking the incremental risk. So when you are not investing in a risk-free investment, let us take State Bank of India. You are not putting for a fixed deposit in State Bank of India, but you are investing into a debenture of Tata Steel or something like that. So you will be expecting a little higher interest because you are taking risk. But because Tata Steel is a AAA company, you will be expecting less premium because very unlikely Tata will default. But if you are taking the risk on Jubilant Organics, I mean those who pizza banate hain, then you may expect a higher interest. The gold loan givers or Shriram Transport Finance Company, they will give you 8% return or 9% return, a more premium, because you are taking a little more risk. Now these are where you are getting fixed return and return of the principal at the end of the term. But when it comes to equity, that's the high risk. Because if a company make profit, you will get money. If the company does not make profit, you may not get money. So your expected return is much higher there. So that is why when people invest in equity or equity like mutual fund, that is pooled equity, people's expected return will be higher, which is nothing but the risk-free return you have, that is say 6.5, for example. Their expected return may be 10%, 12%, 15%, depending on how much risk one can take. If I like to invest in very good companies, top companies, then maybe my risk premium expectations will be low. But if I invest in Zomato and other type of companies which are a little risky, then my expected return will be high. I hope it is clear to you that risk premium will depend on two parts: where I want to invest and whether I can take that risk or not. So these two factors are very important to decide the risk premium which you will be earning. I hope I have made it clear. Now let us understand the types of risk a company faces. These are broadly called unsystematic risk and systematic risk. What is unsystematic risk? Unsystematic risk is a company specific risk. Company's management is not doing well, or it is a cyclical industry. Sometimes can make money, sometimes it may not make that much of money. It is a very competitive area, so maybe their margin will be less, so profit will fall, so the return will be less, etc. So in case of unsystematic risk, you can have couple of different, you can diversify. You can buy some shares from Marico, that is parachute hair oil, and you can buy something from Ultratech Cement, which sells cements in a very with a little premium, and you can buy some IT stocks which are doing well, like TCS and other things, and that way you can reduce this unsystematic risk. In fact, as we progress further studying, you can eliminate almost this risk, almost this unsystematic risk, you can bring down to almost zero. It can never be zero because thoda bahut risk, I mean, a little bit of risk will be there. That's unsystematic risk. But it can be reduced by diversifying your investments. Next, we come to systematic risk. Now, systematic risk is when all the companies suffer for some reason. Suppose government decision, some law, like US has declared tariff. Now, of course, there are some items on which the tariff is not there, but this type of trade embargo, then all the companies are affected. Suppose the interest rate in the economy goes up, then the cost of money for the companies will go up. So that will affect their profit. Now, it's not that Tata Steel will get cheap money and somebody else will go, because the overall money is costly. So this is a systematic risk which is difficult to get out of, to eliminate. And this systematic risk will vary depending on how much you are linked to the risk. Now, I will explain it. Suppose you are a bank or you are a non-banking company like Bajaj Finance and other thing. So if the risk goes up, then you will be affected badly because your loan people may not be taking at high rate. So your business will come down. But suppose Tata is making Tata Steel. So this will be a small component and maybe they can increase the price of the steel, and steel being a very important in infrastructure or something like that, people will buy. Or suppose you are making edible oil and your interest cost has gone up. You can increase the price of edible oil because people will buy oil. It is almost an essential product for domestic household. So same risk, but different company will be affected in a different way. So that is what is systematic risk. We'll learn about it later on, how it's calculated or what is the effect of that. So to sum it up, risk cannot be totally eliminated from a portfolio. How much diversify you make. You may think I will not put all eggs in the same basket, but at least one basket can fall. So the risk of breaking one or two eggs are always there. But overall, if you properly diversified, your overall return will not be falling badly. You may not lose all the money. You may get less return, but you will get return. That is where an understanding of risk and the type of risk premium you expect which depends on your risk tolerance, is involved. So in this slide, I have tried to explain you risk, different type of risk, risk-free rate, and what type of risk you can take, and depending on that, how much risk premium you can expect. So if you are a risk averse, you will be perhaps investing in the banks or putting money in the banks or buying government-backed securities, AAA debentures. And if you are ready to take risk, you may be investing in some equity, and if you're ready to take too much risk, you can invest in startups or risky companies, right? Now we'll move to the next one. Very often, when somebody wants to invest in stock market, people say, your neighbors and other things, why this is a speculator's gambling den, speculator's den, why you are going there? You lose all your money. I mean, a lot of fear factor are told to you. This is a speculation. Why don't you put the money in the bank and get a fixed return or something like that? Somebody is much ahead. He will tell you it's a gambling den. People are investing 1 lakh and getting 5 lakhs, and then some people are investing 1 lakh and becoming zero. So don't. But actually, let us see what is speculation and what is gambling. A speculator takes risk, knowing that more risk they take, the greater is the potential gain or loss. So let us look at the speculator. I am a speculator, and I find there is a rainy season, there is a very good rain. So if rain, there will be good cultivation. If there is a good cultivation, then there will be demand for fertilizer, demand for pesticides and other things. So those stocks may go up. So I speculate and I take risk, and for the short term, I buy those stocks, expecting when they will declare result after the season is over, that is September, October, May, there will be gain, the price will go up. So this is a speculation. Or sometime in July or August, you think the Diwali is coming, the gold price will go up, and people will buy Dhanteras May or Diwali ka time gold. So why don't we buy some Titan stocks? Because Tanishq is selling gold, so the price will go up. So this is a calculated speculation. It may happen, it may not happen. I mean, the expected return may not be as per your expectation, or it can be more than your expectations. So this is a speculation. In contrast to this, gambling is a game of chance. The chances of losing are usually greater than the chances of winning. Just lottery ticket. This is speculation that you may get the first prize or second prize. But in all probability, you don't get a prize, somebody gets a prize, but that is 100:1. Out of all the people, 100 people, if they have bought ticket, 1 or 2% will be getting the benefit. So is definitely not what is stock market is or security investment is all about, because there is some amount of speculation which will come next slide may, but there is a lot of study, historical data, there is a lot of scientific analysis, and then you invest in the market. So you don't gamble. Some people do. I can't say that some people don't do it. They blindly say, some market, they get an information that this stock will go up without knowing what they make, what is the management, what is etc. They will buy the stock. Now, if luck permits, stock may go up, and if the luck goes for a toss, this goes down. I remember there was a company called Usha Rectifier. People said it will be the next Tata Steel or something like that. So people invested lakhs, I mean, 10 rupees they bought at the rate of 300 rupees. But sooner or later, the price became 6, then it became 3. So your investment, you can understand, it was almost totally wiped out. And then in these situations, you don't get any buyer. If there is a buyer, then only you can sell. So then it becomes almost like gambling when you do not know and you enter into the market. As my slide shows, a speculator take risk knowing that more risk they take, the greater is the potential gain or loss. So speculator does some study or analyze, but he is a more risk taker. We'll come to the next slide where we will try to understand investing vis-a-vis speculations and other thing. So speculator versus investor, because investor also speculate. If you are analyzing a company, another thing, you are then thinking of the future forecast. The moment you are thinking about the future will do well, you are taking a probability guess. Am I correct? You are thinking that this company will do well in future. So there is a probability it may not do well in the future. Now let's see what is the difference between a speculator and an investor. The time horizon of a speculator is short, while that of the investor is long. An investor will invest in a good stock, good management, good product, and may benefit a lot in the long run. For example, if somebody had invested in Wipro sometime in 1996, 10,000 rupees, it's a good management, they have good product, they are one of the best in the IT sector, as well as they have soap and FMCG products, etc. They also used to make computers and etc. medical equipments. So now, after so many years, that 10,000 is becoming almost 300 crores. So this is an investor's position who is going to be long. But some people who are speculating, they will wait, no, it's not doing well, sell it. Now let's look for some other stock. So next point, investor expects a good return and a consistent performance over time, but the speculator expects abnormal returns earned quickly over a short period of time. As the sentence goes, as I was telling you, the speculator is expecting I'm putting money here, it's going to go up, I'll make money, and then I'll move, I'll buy something else. So my horizon is to make money in quickly. Third is the investor generally sticks to his or her investment plan because a lot of analysis and other things are done, and then investor chooses where he will invest. So he is more committed to his investment decision. But the speculator is not doing an analysis of that depth. So he makes a rapid shift to the other one. So I know that maybe this winter, this company will do well, but suddenly somebody comes and tells me, no, this company is doing better. So I sell and I try to move to that company. So I may make money or I may not make money. So in this process, from one stock to other, I start moving and make small profit rather than sticking to a stock and making big profit or good profit over a long period of time. I repeat this once again that speculators also do study another thing, but they are in a hurry to make money. In the process, sometimes they lose, sometimes they make money. So overall, they may make money, but that would not be as good return as investors who has the patience and the staying power, not blindly with eyes open, observing the companies where they have invested, they are doing how, etc., and they earn a better return over a long period of time. Somebody invested in Asian Paints, somebody invested in Ultratech Cements, somebody invested in Bajaj Finance. They have got a very good return over a period of 10 years. But if you are shifting here and there, you will get part of that profit. So it will be small profit. I hope I am trying to make the point clear about the between speculator and investor. So if you are speculating in the market, the chances are that you miss some profit and settle with a less profit. And that is why the last line is that investor is risk averse, but the speculator takes great risk. So investor takes risk, but after studying, and then he sticks to it. But speculator is greater risk. If he thinks or gets the information that, okay, this stock is going to do well, X, 6 महीना में तो जंबो हो जाएगा, and they invest their money there, and something goes wrong or doesn't happen like that because the management is not good, all information is not there, so they do not make money, but they do take high risk. So in this case, for speculator case, high risk may not necessarily be high return. Whereas in case of investors, in the second point, as I said, you'll get a good return. Good return means, as I told in the earlier slide, you get inflation adjusted good return and a consistent performance over a long period of time. Whereas a speculator, because his nature, he is looking for short-term profit, he may or may not make good profit. That is the difference between a speculator versus investor. But for all of you, speculation has to be there in the market because the speculation keeps the market moving. Some people, but if it is all speculation, then is a problem. Speculation has to be justified by something or other. And beside that, there are some speculations which are done by we call them day trader or positional trader, short-term trader. They do speculate and they keep the market moving. So what you see the market up and down, many times this is the role of the speculators in the market. And sometimes they gain, they sometimes lose, sometimes they gain not as per their expectations, but much below that. Okay. Let me have some water. Now, everyone should have an investment objective. Financial goals and objectives determine portfolio asset allocation and based on individual's time horizon, risk tolerance, and financial situation. So naturally, suppose I am trying to invest and save for my daughter's marriage. So my risk tolerance will be something different. My time horizon will be something different because if she is now 3 and I want to get her married by 23, 25, so 20 years is my risk horizon. And my financial situation, suppose I am a salaried employee, I will put a little money every year or every month and etc. But here my financial goal is to make X amount and object is my daughter's marriage. Similarly, if my objective is after 6 years, my son or daughter will go for higher education, so I will put the money accordingly, depending on the time horizon, what risk I am take. Accordingly, I'll choose shares or debentures, and what is my financial situation. Suppose I get a lump sum money from somewhere, I put the lump sum money in some stocks or some mutual fund, which is consistently giving a good return like that. So investment objective is very important. Now let us understand what are investment goals. A set of goals that determines an investor's financial portfolio is known as an investment objective. So your goals determines your objective. Once your objective is, your goal is clear, then you know that I have an investment objective. Now, once you have investment objective, a financial advisor, I mean the role which CFP, Certified Financial Planner, or investment advisor approved by SEBI, They decide, they analyze different stocks and find the best strategy so that you can achieve your objective. Now, here, the input they need is your risk tolerance and the time horizon. Are you ready to wait for 5 years, 7 years? And can you take a little risk? Because in between, price may go down or price may go up. But at the end of the 7 years or 8 years, the company will do well. So that's how you're determining an investment goal. I'll just give you an example. An anecdotal investment. When the now Airtel, at that time, also it was Airtel, Bharati Airtel, when they came, the share issue was 42. They did not give any dividend. But you have to wait. People knew that it is a big future. So if you remain invested in that for a longer period, you will get a good benefit. And people did get. Similarly, TCS or Wipro, I have already told. Infosys, I have already told. Titan, let us take. Titan Industries. It makes watches. Can you name any other watchmaker in India now? Perhaps not. So one is monopoly position in the watch market. Undesigned, different marriage, etc., etc. 60 lakh marriages happen, so 60 lakh pair of watches. And then they have Tanish, the gold, and Tata brand. So in the long run, they will do well. So the share price, which was 70 rupees, 80 rupees in 2008, became 3,000 by 2015. So 7 years in between, prices has come down, gone up. But in the long run, those who have time horizon, they have made money. So depending on your investment goal, your risk tolerance, because it's Tata, you can take some risk. Your time horizon you have, and you benefit from there. Now let's see investment environment. So I have told you about, just a minute, investment objective. It should be very clear. What is my investment? What is the time horizon? What is my risk tolerance? And what is my present financial situation? Now let's get into the things which you'll be learning in details later on. Once you are able to frame your investment objective and also identified securities that are to be purchased. So your security analysis is done. You know these are the securities I'll be buying. And then your portfolio manager, he decides how much of which security I will buy, etc. But the main thing happens now. Ultimately, you have to purchase and sell securities from the market. So you have to have a knowledge of market. You need to have a detailed operating knowledge about the market, who are the participants, who are the infrastructure providers, etc. So these are the knowledge of the following three pillars are very important. We will study these things in details later on. I'll just touch upon this. First is financial market, stock exchange, depositories, clearing corporations. I'll explain those things later on. Just now you can remember these things: stock exchanges, depositories, and clearing corporations. These are all financial market infrastructure institute. They give you the infrastructure through which everything happens. Financial instruments, equity, and when you put it through the pooled, then it is mutual funds. There are debentures, which are fixed income securities. There's something called zero interest debentures, which takes you 1,000 after 10 years, maybe giving you 2,500, like that. Bonds are generally Government of India instruments are called bonds. MF units or units of mutual fund, which is a pooled investment, because individuals may not have the knowledge of the market analysis and other things, so they can put the money with a mutual fund which are managed by professional fund managers. So if you are a busy person otherwise, you can buy units of mutual fund, because this money is be pooled and it will be managed by professional money managers who will be analyze the stocks, buy the stocks, diversify your portfolio, and you can choose which fits your goal. You can buy that scheme. ETF is exchange traded fund which are available in the market and you can buy them. They reflect what their objectives are. So every ETF has some objective. It matches with you, then you can buy those. These are different type of financial instruments. And last but not the least, with whom you'll be regularly dealing are brokers. I'll start from the end. You need their help to buy or sell shares. There are merchant bankers who participate in initial public offer from where the new securities they come in the market, and they play a very important role where private companies become public companies, so the shares of them are available in the market for ordinary people like you and me to buy. Look at Zomato or look at any other company, Paytm or earlier Tata Steel or Reliance Industries. Somebody has told those management, why don't you bring out initial public offer and offer the shares to the public and raise fund so that some people also get benefit of your growth. So this role is done by merchant bankers, and RTA is registrars and transfer agents who maintain the registry of who are the shareholders. And when you sell and buy a new stock, the transfer activity is taken care of by these RTAs. So these are the different intermediaries. Broker का सब broker रहता है, उसका authorized person रहता है, who works on behalf of the broker, and they are all to be registered with SEBI. SEBI is the regulator of the securities market, about which we will be learning later on and in details. So everybody has to be registered with SEBI and follow SEBI's guideline. This is the investment environment in which you will be dealing in securities. You will build up your portfolio and you will make money. Now my last but one slide is investment process. Investment process is a key process entailing the whole body of security analysis and portfolio management. So far we have talked part by part various things: security analysis, diversification, portfolio management, but there is a process involved in it. A typical investment decision undergoes 5-step procedure, which in turn forms the basis of investment process. You should understand that. And if you follow a process, you will be, generally you will not go wrong rather than ad hocism. These steps are: first is determine your investment objectives and policy. So if you are starting your investment journey, you may have to create wealth, or you may have some objectives like I told, your daughter's marriage or your children's education, your retirement. So everything has a different type of time frame, and you have a particular risk profile. The risk you can take, it is generally given. You are by nature may not be a risk taker, or maybe risk taker or thoda risk taker, something like that. So this is important, and based on this you will be preparing your investment policy, or you will be guided by professional money managers. They will do the security analysis. Now the question is that when I analyze a security, I look at the broad picture of the country's economy or international economy. What now it seems like there's a growth time or the good time is coming. So which companies are supposed to do, or good or bad time, which companies are supposed to do Who's the manager, who is the management, are they credit worthy, or have they delivered good result earlier? Like if it is a good name like Mahindra Mahindra or Tata's or Maruti Suzuki and other things, you choose those companies because they have a proven track record. But that does not mean you will not touch new companies. Maybe they have a good idea. So you have to understand whether that is feasible, that is practical, and or based on that you have to analyze and find out how the company is going to do in future. What is the risk in that? They can be small company, they can be mid cap company. That's how the companies are segregated in the stock exchange. First 100 companies are large cap companies, and then 150 companies are mid cap companies, and below there are small and micro cap companies. So generally, small cap is not a big management other thing, but they may be good. So you analyze all these things and try to study their expected return, etc., and then you construct a portfolio. Portfolio means bunch of shares, debentures, etc., which balances your risk, at the same time balances the expected return from your investment, and then periodically you have to review the portfolio. When you review the portfolio, that means these are the stocks I purchased with these expectations, whether they are happening like that or not. Don't be a hurry, don't do every day, but do it periodically. And then you see the performance, whether it is as per your plan, as per your goal, it's going or not. If not, then you may change some shares, some stocks, some security. You may add, you may delete, like that. So these are the steps which are involved to keep you on the track and get the result, the desired return with the risk you are ready to take. So this investment process you have to follow. We'll study much more on later on, and this process is a sacrosanct for anybody who wants to not to be a speculator or a gambler, but want to invest in the stock market or securities market and wants to create wealth for him or his family, or maintain those commitments, his objectives, that is somebody's marriage or somebody's education with his investments, and as well as the retirement planning. So far we have understood from the beginning about, I'll just do a quick recap. We have done about, which is important here is real return and nominal return, which is inflation. You have to keep track of it, whether your inflation rate is giving you a real return which is more than zero. Definitely 2% or 3% real return is must for somebody who is investing. If you are into equities or another thing, it should be much more. So that is very important understanding. Okay. Second is the risk and risk premium. By habit, we have to take some amount of risk when you are entering into the securities market. But the question is how much risk I can take. Now, it all depends on your financial situation, your income, and etc., etc. So accordingly, your risk will depend. And risk, how much you take, on that you will get premium. It's not necessary that if you take too much risk, you get too much of return. Then you become a speculator and you land up in different place. So there is a difference between gambling and speculation, but speculation is there in the market. But as an investor, you don't do much speculation. Finally, I have discussed about the investment process, which is the core of any investment management techniques. And you have to follow this discipline, and that's very important. And we will learn more about it in future as we progress with this course. So more on the next sessions, we'll study in details about the securities market, risk, return, and it's, as I told you, about financial intermediaries, primary market, secondary market, etc. So all those for the future. Thank you.